So the effect should be, first, we're going to go in some kind of a slowdown. We're already in slowdown and probably a recession. I think right now I'm moving closer to that camp that says it's going to be a recession. And I think it is going to be based on the economic reports. So if the interest rates come down, meaning the bond market's going to rally, the dollar will have problems with that, and the dollar should come down as well. So it had a great rally over the last couple of months. I think that rally is almost over. And I think the dollar, I'm kind of bearish on the dollar at the moment because of interest rates, because of the possibility of a recession.
Right.
If the dollar is going down, then the next domino is commodities.
Good evening, Dennis. How you doing?
Good, Andy. Good to see you as always. How are you?
No, it's really good to see you. Let's talk about the markets here. What are you seeing? It looks like the stock market's not going anywhere. It's been trading in a range. Oil's broken out, but it seems a little bit overbought. But really, I think we discussed offline that the bonds are really the big story. So let's talk about the bonds. What are you looking at in the 10-year?
Right. Well, as we talked, you and I, the last 3 months, we were more positive on the stock market. We were positive on the economy in general because the economic reports were encouraging. So throughout the spring and the early summer. But over the last couple of weeks, the economic reports are showing that the economy is slowing down, which is expected, and it's been expected for over a year now with the inverted yield curve and what the Fed is doing and first the money printed, then the other way around. They're trying to slow the economy down to fight inflation. Everyone knows it, and I think it's finally starting to show up. And especially it's showing up in when it comes to smaller businesses. While the Nasdaq stocks and bigger stocks are still okay because they're not as reliant on interest rates as much as the smaller companies, but it's really starting to hurt real estate first and smaller businesses in general second.
Right.
And as we know that small businesses employ 65 to 70% of people in the United States. And what we see from the pure economic standpoint, the debt, not the government debt. We know this is a longer term concern, but as far as short term concern, the consumer debt, credit card delinquencies, huge credit card debt, car payment delinquencies, people who had variable rates on their mortgages. And the real estate is just not just slowing down, but kind of the prices are not crashing yet, but new houses and people are not buying houses at the moment. So it's slowed down dramatically.
Right. Let's work that all out, especially let's start with the real estate sector. And I'll give you an example. My wife and I are we're looking to buy a new home during the summer, but we hold off because we were assuming that interest rates were going to continue to go up. We don't need a new home. And so we weren't like thinking, hey, we need to lock something in right now. But our thinking is let's maybe wait for interest rates to come down.
Right.
Well, we found a dream home, if you would. It's in Atlanta. Very, very beautiful. It's an upgrade as far as acreage and as far as rooms and that sort of thing, and it looks beautiful. It was around $900,000, and they just cut the price, and it's been on the market for about, I want to say, since May. They just cut the price $150,000.
Whoa.
Yeah, and there's still no bid.
Yep. And that's a function of interest rates.
Right. And so we did the calculation of what our mortgage payment would be, which my mortgage payment right now is about, I'm calculating, I just know it with taxes, right? Property taxes, but our payment with not including property taxes, around $1,500 a month. Our mortgage in that home would be $5,000 a month. So it's, of course, we're going to wait. And so it just got me thinking, who would buy that home? And also, why have a sense of urgency to buy?
Yeah.
Where we're fine where we're at, we just want an upgrade.
Right.
But why would we buy? And I'm wondering if that is the thought process now.
I believe so. I believe this is an excellent example of how a lot of people think. So whether people want to upgrade or they want to buy their first home or what have you, or they move from one state to another, and with these interest rates, I mean, people either simply cannot afford it, or if they can, they're wondering, why would I pay so much?
Right.
So now the question is, what's going to happen to interest rates? And I think with the economy coming down, I think interest rates are going to go down, not up. So it's good to wait.
I agree.
Inflation is still there, right? It's not as bad as it was a year ago, obviously, but it's coming down. It's getting better. So the Fed is doing, I guess, the right thing, right? The question is it going to crash the economy or it's a soft landing? So right now, let's hope for the soft landing. That's the best case scenario. So what I'm thinking is, in terms of the markets are concerned, interest rates are going to come down, maybe not dramatically, but come down. The Fed, I think, is done raising rates, because if you look at Fed funds futures, they price in only like 9% chance of them raising. So essentially zero.
Right.
I don't think they're going to cut yet, but it's too far away from that. So the effect should be, first, we're going to go in some kind of a slowdown. We're already in slowdown, and probably a recession. I think right now I'm moving closer to that camp that says it's going to be a recession, and I think it is going to be, based on the economic reports. So if the interest rates come down, meaning the bond market's going to rally, the dollar will have problems with that, and the dollar should come down as well. So it had a great rally over the last couple of months. I think that rally is almost over. And I think the dollar, I'm kind of bearish on the dollar at the moment because of interest rates, because of the possibility of a recession.
Right.
If the dollar is going down, then the next domino is commodities. Lower dollar is better for commodities. Look what the crude oil is doing while the dollar is going up. That's almost counterintuitive. Crude oil and energy markets are doing great. I mean, it's a leading sector now. I think it's going to do even better. It's a little, like you mentioned, it's a little overbought now because we've had a great rally. Maybe we'll pull back, maybe not. Long term, it's still very, very bullish and still cheap. But if the dollar is going down, the commodities are going to benefit the bid to crude oil, and the gold that's been kind of in a rut, last few months. I think it's finally starting to look a little better, especially crude oil did very well, even during the dollar, when the dollar was going up. I think it's a little overbought, just like you mentioned in the beginning. But I think if the dollar is coming down, which I'm expecting, it's going to be good for commodities, especially crude oil. And thinking of gold, that we mention gold all the time, and over the last few months, it's been, kind of a downtrend or going nowhere. I think it's finally going to benefit. It's going to benefit because of that kind of domino. So interest rates down, dollar down, therefore gold probably up. First, because it's measured in dollars. Second, because it's a hedge against anything bad. And I think if a recession hits, then gold would benefit. And I'm starting to look at it from a positive standpoint, not just long-term years, but I'm talking about a few months. Yeah. So gold could be a good thing. I can show you a chart. Let me share the screen of just interest rates.
Please.
Just a second.
And I have some thoughts on that too, after your chart. And I agree with you. And I'm going to throw somewhat of a fly in the ointment of Fed dropping interest rates, but I do believe they will. But there's a tension there I want to talk about. Go ahead. So what are we looking at?
We're looking at the chart of a 10-year note. So if you see on the left side, that's last October, that's how high it was. Basically, we just tested it. And if you look at the very short term, it's sort of trying to do like a head and shoulder formation, pure technical terms. I think it fits to our fundamental theory that we're discussing, that it's probably going to go lower. So, and if you look at the dollar, I'll put a chart of UUP, that's proxy of the dollar. See, it had a very nice rally starting from July, and it's still kind of there. I think it's overdone. I think it's going to go down. And if we look at gold at the same time, this is GLD, another ETF proxy. I think it's starting to look a little bit better. So I don't have
it's interesting. Excuse me. If you look at the chart of the dollar in November, how strong it was, and it started to roll over.
Right.
Look at that, and it rolled over. Then you look at gold.
Yeah, look at gold.
Gold rallied in November.
Exactly. So it's almost the exact opposite.
Exactly.
So they're not 100% inverse correlated, but one affects the other all the time. And I'm thinking that sort of a repeat of that is in order. So I don't know how significant the rally in gold is going to be, but I'm going to stop sharing. So,
another thing though too is interesting. What your thoughts on this is just the seasonalities of gold now. And I look at that not as a primary reason to buy, but it's kind of like the wind at your back type thing.
Yeah.
And the seasonalities for gold right now, this is the time to buy. So
yes, September usually is the month to get in. So, and I think the confluence of all those developments that we're talking about, plus the seasonality, I think benefits gold. And I think if you look at it in technical terms and find your spots and do some maybe option strategies, or just whether you're on the futures side or on the ETF side, and
or even the equities, I think they would be buyers by the equities right here now as well.
Oh yeah, absolutely. And I usually tend to, and every time, I think almost every time when we talk energy, I don't buy crude oil. I usually buy equities or ETFs. Yep. So I think they benefit even more than the commodity. A good example would be, where is crude oil now? At about 86, something
80 like that. Is between 85 and 86.
Yeah, so somewhere over there, which is relatively high,
right.
That's a good price.
Well, let's talk about crude. Let's talk about crude. And it is overbought, technically speaking, but I've been looking at the API reports that come out on Tuesday afternoon.
Yep.
And they're showing historic draws. And it, to me, looks like, and correct me where I'm wrong in my theory, but now the crude oil story in the first two quarters was a demand story.
Yes.
Right? Okay, things are slowing down. Things aren't rosy with China, whatever.
Yep.
I believe now it's changed to a supply story, where we're having a supply issue. If you just look at the fundamentals with crude inventories, right now, we are exceptionally low.
Yeah. Yeah, look at these reports. You're absolutely correct. So it's still, when we mentioned that it's overbought, we're talking very short term.
Very short term.
We're talking about a couple of weeks, if that. I mean, they might not stop. But
so really, a strategy would be any kind of weakness if you trade this, and this is what I'm doing, and I'm already up to my eyeballs in crude, is I would be a buyer.
Oh, yeah, absolutely. And the reason we mentioned equities on, for example, energy equities, right? Even if crude oil corrects a little or goes into range, even if, right? A lot of energy stocks, energy equities, whether crude oil is at 86 or 82 or 90, it essentially doesn't matter for them. They're printing money. So
Yeah.
unless crude oil reverses and goes down, which I don't believe it will,
Right.
then they're going to do well. They're
Yeah.
going to be great. And remember, we talked about how cheap they were. They were
They're
like,
still exceptionally cheap.
they're still cheap. Another 15-20% rally in equities, energy equities, would make them fairly valued.
Right. Fairly valued, and they'll still be cheap, just not stupid cheap.
Just not stupid cheap. Yeah, it's still okay. So that's
Right.
why I prefer equities, even if I say, okay, even if we correct and go nowhere for a few days, weeks, they're going to benefit. They're going to benefit. They're printing money.
Yeah, and really what you're doing as a trader is you're arbitraging the oil market in the sense of equities haven't caught up to where crude is currently now.
Oh yeah.
And so if crude goes even higher, which we both expect it to by the year's end, if not longer term, I mean, that's just, again, your leverage play is in with the equities.
With the equities, yeah. And sometimes even the smaller ones, like a smaller cap or mid cap energy equities. And
I actually prefer those, yes.
Yeah, and same applies to precious metals.
Same applies to precious.
Same theory. So you can buy Newmont Mining and all those guys, ABS and so on.
And you get a double, but the other ones are going to get a triple or a quadruple.
Right. The diamonds in the rough there that people don't know, and we research and actually researching a few. Maybe next time we talk about a couple of them. So but
so
that's go ahead.
Well, this leads me to another thing about the Fed stopping and perhaps lowering maybe in the first quarter of next year. So the fly in that ointment is crude.
Yeah.
So if crude oil is where it's at now, if not higher, would that prevent the Fed from cutting?
Might be. It really depends on the severity of the economic slowdown.
Yes.
If it's a minor one.
That's a really good point.
Yeah, if it's a minor one that everything is fine, they don't have to cut, or they do a symbolic one cut, something like that, saying to everybody, we're on top of that. It's a symbolic thing. But if it's a harder landing, recession, where people losing jobs and things that are in trouble, they'll forget about crude oil and gonna start cutting. So it's inevitable. It's a little too early to say, but like I said, I'm moving towards that camp that things are not going to be that great economically over the next several months.
Yeah,
I know how to get out of it, and we're not talking about some China problems which could, create a domino effect, or other geopolitical things. We're talking about just what's going on here, because high interest rates are suffocating small businesses now.
Yeah. Okay. So we know that it's suffocating small business. And again, my family is a small business owner. What other sectors would you be very negative on as things slow down? I'm thinking bank stocks, you'd have to. Yeah.
And they've been lagging for months. They can't get out of that mud. I mean, look at regional banks. They tried to rally. Nope, it didn't happen. Even bigger banks, and they are okay. None of them are really in trouble. It's a regional banks who might be in trouble. They still look at XLF. That's a banking ETF or banking index for that matter. It doesn't look good. Right. And you're absolutely correct. That's the first one. Well, second one. The first one would be real estate stocks. Right. I don't think they can do well over the next few months. I just can't believe them going up. In the best case scenario, they'll just stand here. But I think they're going down. So everything related to real estate and banking is probably the worst. Industrials they might suffer too. So
or automotive.
Oh yeah. Those. If you go to like a small industries, right? Yeah.
Or even retail stocks, even like the big players, like
sure. I mean, if the consumer is a little bit of a trouble, and that's it's written all over it now. Right. Then,
but I would go to high-end retail, so like the Nordstroms of the world, if you would. those
I don't think they're going to
concepts.
do well. Even Amazon and Walmart, we're talking about huge ones, even they are going to suffer. So people just a little, they'll contain their purchases and things like that. So
So
those
in
ones are
inflation, we're kind of talking like deflationary environment here.
sort of, yes.
Where do you hide out in?
Ooh, commodities. Even in deflation, still commodities, because I
Yeah, I
believe that.
agree. I think it's the
Deflation
place
doesn't mean that commodities are going to go down. I mean, yeah, demand slows. I understand it could put a lot of pressure, but if the dollar is going down, commodities, that's my preference at the moment. That is
Yeah,
my preference.
that and probably I'd be buying the 10-year right now as well.
Yeah, bonds, yeah.
Yes.
That's a chart that we looked at and so on. Yeah, 10-year. Remember the 90s joke when Nasdaq was going straight up and the traders were saying, hey, if there is a trouble on the horizon, a recession, you put your money in the risk-free assets. There are only two of them, US Treasuries and Nasdaq 100.
Yeah, right.
Because nothing can stop Nasdaq 100.
Right.
Until it does.
Until it does. I remember that.
Yeah.
So yeah, interesting times. So, well, yeah. Any parting thoughts that you have for the next week or the time we meet again?
Let's look at let's see what the dollar does. Interest rates on the dollar. Right now, the stock market is reacting. Bad news is good news. I think it's going to stop at some point.
And bad news will be bad news.
Yeah, and bad news. I mean, and all of a sudden, some unemployment report or some, housing starts or what have you, shows some really big draw, and they say, "Oh, what are we so excited about?"
Yeah.
It's about the recession. It's about the earnings, after all. So
Yeah.
when that changes, then everything that we talk about will come to fruition. And I think we're not too far away from that.
Yeah. So look, before we go, not too far away from that, if we get a sell-off, and I agree, you're looking at September and October sell-off. That's when they typically happen.
I usually, yeah, but sometimes markets top in October, not bottom. So we'll see. But yeah, it can start. It can start anytime.
Yeah.
I'm not as positive on equities as I was. So in fact, get negative, although technically they're still okay. So I need confirmation from the internals, from the technical indicators. So far, I'm not going to go and say, all right, it's short term, not yet. But I'm waiting for that confirmation from a technical standpoint. But from a macro econ standpoint, I don't like it. I don't like the situation where we are.
This is not good. Yeah. Okay. All right. Well, thanks, Dennis. We'll chat with you next time.
Thank you, Angie. Anytime. Appreciate it.
Yep. Bye.